Welcome to the Best of US Investors, two regular guys show. This is Mark and I am Trent. And today we're going to get in China's central bank decision to get aggressive about restarting their economy, along with a couple other items that Mark and I just started talking about. We talked about the Fed and its 50 basis point decision to lower rates, even though things are good. And we're going to get into a couple other items. So stay tuned, and here we go. Does it seem to you that this aggressiveness in the Fed funds, just how fat, aggressive throughout the world, everybody's adjusting? Is it a red flag to you that it's not just one country, it's most countries and they're getting really, really aggressive with it? I mean, is
Yeah,
that
yeah, it's tremendous red flag. It's the whole world is in this together. China's God, it's been what 3 years since they started with their real estate, you know, Evercore or Evergreen or whatever that was.
green?
You know,
Yeah.
that thing failed, and now everything's slowed down in China. Same in Germany and Europe. I mean, this is a global event um, that's going on, and I think maybe you know we kind of did it to half a point to give some of these other countries a little breathing room, you know,
Yeah.
to do the same thing. Yeah, they're in trouble. And we live in such a bubble because we are a CNBC world. And Steve Leisman and all these guys get up there and tell us how great it is. And the Fed tells us how great it is. Every single report you get from the government, the headline is always, hey, inflation's up less than expected. Okay, even though it's up,
Right.
they spin it, and that's all anyone sees or hears on the radio. When in between songs when they come on with their news briefs. Oh, inflation went up less than expected today. The Fed said that it's under control and they can you can lower rates even further because we're all fine. Okay, now back to my day. You
Right.
know,
Yeah. Well,
I
it's
mean, if
interesting.
it's if it's if it's that great, why isn't our market taking off? I mean, we're at all-time highs, but we're not like doing 600 points a day.
No, no. And it was funny. Somebody on my Facebook page posted this picture of the Dow Jones. It was at 42,000 something. And it's then Harris and Biden pointing at the numbers. And the lady wrote in the caption or in the thing, um, we did this. Or no, it was on the picture. It said, we did this. And I'm like, yeah, you did. You increased the national debt by $1 trillion every 100 days. You flooded the system with money, and all that money has gone into the stock market and make billionaires richer. And yet you're saying tax the hell out of billionaires. Yet you want lower rates. You write letters to the Fed saying lower rates 75 basis points makes money cheaper, which means billionaires make get more borrowed money, which then they multiply that borrowed money more and more, and they get wealthier and wealthier. They just don't understand how this all works, and
No,
that's
because they all they see is Steve Leisman and they want happy thoughts, and Lester Holt, and that's it. They don't dig into these reports. It's almost every time I have to look at one of these reports, it's half sad and half comical, you know. And I'm like, am I am I the only one that sees this, or am I not reading this right? And I have to go back over it. Like, huh, that's interesting. You
yeah.
know,
I'm
it's
like,
like
am I
the
just
housing. It's like the housing numbers came out and say, oh, the price of housing year over year didn't go up as much as expected, but it went up 6% from last July. Okay, that's inflation. Okay, well, how I thought housing was supposed to be coming down. I thought, how is
right?
housing prices going up? Your neighborhood is right there. I mean, you've got houses for sale everywhere.
Yeah, and nothing's selling. I mean, I go by these houses that are for sale and they're empty. And granted, most of them are Airbnbs, but there are a couple of full-time residents who took the opportunity to go buy another house, but now they can't sell that other house, the house they moved from. And it's like, that's going to catch up. That's going to catch up in a big way. Um, and then it's, as you see this lowering of rates and the bond market pushing lower, it's like you lower rates on mortgage rates, that floods the market with more people to buy houses, but the average house in the United States, 400,000. What does that do to the price of the house when there's more demand? It drives the price of the house up. So it's like, understand what you're asking, really think about, you lower rates, you say there's a supply issue in our country when it comes to housing, and housing prices are average 400. If you lower rates and create more demand, what's going to happen to those prices of those houses? What's going to go from 400 to 425 to 450 to 500? And then it's really going to be pricing people out of the market.
No, you wait
And
if,
then if you give them a $25,000 credit
oh, it's
for first time
50,000
home
now.
buyers,
50,000.
as a builder, wouldn't you just raise the prices 25,000?
Absolutely what's
Yes.
going to happen.
So what's the fix?
Let
How
the
do you
free
manage
market,
something
let the
like this?
free market take care of it. The problem we're having is the Federal Reserve. Federal Reserve's fiddle farting around with our interest rates when the market should be doing it. It doesn't matter anyway. Those guys have lowered rates by half a point, and the 10 years gone up. Okay, 10 year is the rate for housing and
Yeah.
mortgages. Okay, so they don't
Hmm.
affect crap. Okay, so the free market's saying no, this ain't right. Okay,
Yeah.
this ain't gonna happen. You know, um, what's the incentive for a bank to lower your credit card? Why is a credit card rate at 22, average at 22.7% when the Fed rate is at, 4.75? Those don't match up. Are they going to lower it to 22.5% because the Fed rate went down? Shit.
No, I mean, the credit cards are determined based on prime rate, which is basically 300 basis points plus the Fed funds rate. And then they create the spread, which if you think about it, like if the prime rate is at 7 point, say 85, and your credit card interest rate is at, I would say on most Americans is between 25 and 33%, based on credit score. I mean, you have to have a really good credit score to have a credit card these days at 22, right? So look at the spread they're making. Do you think they're going to adjust that lower? No, they've taken so much risk, and with default rates so high right now, 90-day default rates are so high, at like all-time highs. Do you think they're going to reduce their hedge? No.
Hmm.
Come on.
Come on, man.
Come on, man.
Here's what your dad would
Yeah.
say. What?
So anyhow, I just think there's such a disconnect on how the money system works in our country and throughout the world. And you know, if you're Democrat and you're in favor of, hey, lower rates, understand how that money's going to be used and who's going to get access to it. It isn't Joe and Jan, down the road, uh, buying a house. It's multi-billionaires, nation states who are going to get that money and they're going to leverage it up and they're going to make money on it. You and I don't have access to that.
Mm-mm.
So
No, do I
I don't
want
know.
any
I
of
don't
it.
think
I
they
don't
just
want.
don't know what they're
No.
talking about.
I mean, we're a debt-based society. We have to have debt for the system to work. And when the system locks up, there's no liquidity and banks aren't lending. We're not we're not we're not functioning as a debt-based society. We're not making any more money. So the Treasury is just printing it, okay, through
Right.
Treasury bills, T-bills. Okay, that's fine. That doesn't cause inflation, does it? Woohoo! Yeah.
Yeah.
And now the rates of T-bills are coming down. Who's going to fund this government? I mean, if you and I and the rest of us who took over from China and Japan who used to buy them. If they're only going to give us crap rates, I'm not going to go buy their bills, you know?
right? Hell, and they're not going to buy those bills.
No,
Nation states who used to buy them, if they're going to be crap rates, they're not going to buy them. They'll
it's
go do
probably still
something
better
else. And
for
I think
them,
you're
but
seeing some of that.
yeah,
Hmm.
yeah, yeah.
So, well, tell us about China and what's going on there.
Let's talk about China. I call it the China syndrome.
All
As you
right.
know, well, a couple of years ago, Evergrande came out and there's a big property development company and pretty much said stop paying their bonds, okay, to bondholders. And basically the whole infrastructure of real estate, which is bigger than the stock market in China, came tumbling down and people lost money. And it just takes a while for that to go through the system. And that's what's happened with China. You can see that China has had a horrible economy. Okay, it's a planned economy. Their economy is planned to grow 5%, okay, every year at least. And if you don't hit that 5%, then someone's in trouble, okay? So they got to figure out how to do it. So today, I mean, the world stocks this morning before our market opened hit a record high uh, when China unveiled stimulus measures to support its economy and stock markets. Stock markets was really interesting. You don't usually see a company or country try to, support their stock markets, other than I guess that's what the Fed's doing for us too. Sending
Right.
Asian and European shares higher and triggering a bounce in commodity prices. So the People's Bank of China governor, who's sitting right behind me in his building here, Pan Ganxing, I hope I said his name wrong, announced plans to lower borrowing costs, okay, lower rates, eject more
Yep.
funds in the economy, as well as to ease household mortgage repayment burden. That sounds familiar. Pan also said China would roll out structural monetary policy tools for the first time to help stabilize capital markets. So, what are they going to do? Well, in a nutshell, People's Bank of China will reduce the 7-day reverse repo rate by 20 basis points. People's Bank of China will cut the reserve requirement ratio by 0.5%, a move that'll free up 1 trillion yuan or $142 billion in liquidity. And what that means is the banks don't have to have as much reserves to cover their loans. There's always a good idea, huh?
Oh, yeah. Perfect.
Yeah. Uh, the PLBC will also lower the rates for existing mortgages and they're going to just lower the rates like we did, okay, and cut down payment ratio on second homes to 15% from 25%. So they're trying to reduce the cost of homes and mortgages. The deposit rate will be lowered to neutralize the impact on bank margins. Okay. So they're really looking to put money back into the system, get the economy going again, get the people back in. So this is basically to ensure that China can deliver on its 5% growth target. The People's Bank of China governor also said it would set up a swap facility allowing securities firms, funds, and insurance companies to tap liquidity from the People Bank of China, basically borrow from the People Bank of China based on their assets to buy stocks in an attempt to buy out the country's stock market. That'd be like the US government saying, okay, you can put all your assets over here, which is kind of what we've done, okay, with our bonds when we
Yeah.
had the when we had the Silicon Bank deal. Uh, Banks could go and pledge their low rate bonds and get loans, which they took out and they bought higher rated bonds and made money off of this anyway. So the banks made money, but that's kind of what they're doing. But they're trying to do it to stoke their stock market. Okay, brokers, funds, and insurers will be allowed to pledge assets in exchange for liquidity for funds and stock buybacks. The PBOC will also set up a separate specialized refinancing facility for listed companies and major shareholders to buy back shares, raise holdings. In other words, China is greenlighting direct intervention in the stock market to prop up their stocks. Okay. And when you think about it, it's kind of what the Fed does when, everyone wanted them to lower rates so the stock market goes up, which I've always said, why do we need it? Because the stock market is at all-time highs. It was at all-time highs before they lowered rates. Okay, so here we are.
Yeah.
So as the market, since we've gone down, we're going to cut 50 basis points, just raced off into the country? No, not really. If you look at the charts, we're still hitting up on the intermediate resistance levels. Okay, but we'll see what happens. So China's making it clear it's not playing around anymore, with Bloomberg reporting that China plans at least 500 billion yuan in liquidity support to stocks. Okay, think about that. The United States government said we're going to put 500 billion US dollars in liquidity support for stocks. Okay, if you don't have a liquidity in your market, in your stock market, that's an issue. Okay, why
Right.
don't they have liquidity? Do their people not have money? Do people not believe in stocks? I don't know. I'm not a Chinese expert. So this comes after a surprise and unprecedented 50 basis point cut in the Fed's fund rate last week as Fed participants projections for core PCE inflation in 2024 and 2025 is expected to remain above their 2% target. Okay, their target was 2%, still going to remain above 2%. They never hit it. And unemployment at 4.2% currently is expected to rise to 4.4% in Q4 in 2025 before going back to 4.2%. So they're cutting rates, even though they haven't hit their target in interest or in inflation, and they haven't hit their target in unemployment. In fact, unemployment's going to go up, but we're doing well enough that we can cut rates. Okay. So, the last two times they cut rates by, more than 50 basis points or 50 basis points, the economy fell into recession a few months later. The first time was January 3rd, 2001. And the result was over the next 448 days, the S&P 500 dropped nearly 39%, and the unemployment rate jumped by 2.1%. Then on September 18th, 2007, we know that date, they did it again, another 50 basis points cut, and the S&P plunged by 54% in the following 372 days. Unemployment surged by 5.3%. The recession lasted until mid 2009, made worse by the housing market collapse and the global financial crisis. So, by deciding to cut rates by 50 basis points, the Fed has effectively abandoned its inflation mandate to focus more on the rising unemployment issues. Okay. So, we haven't really solved our issue like the Fed and Powell was talking about, last week, that everything's fine. We're just going to make sure it stays the same. What we've actually done is we're in a panic mode. I think, and 50 basis points is a panic mode. It's not normal. Why cut rates at all, or why not just 25%? 25 basis points. So yesterday, the Atlantic Fed President Bostic said that progress on inflation and the cooling of the labor market have emerged much more quickly than previously thought, to add to bets of sharp rate cuts in the upcoming meeting. So, meaning he's thinking more sharp rate cuts. Well, if we've had progress on inflation and we've had, the labor market's cooled, but we've in control, why do we need sharp rate cuts? I don't know. I mean, it's divergence for me. So
Right.
he's talking about inflation. Okay, we've made progress on inflation. So how's inflation going? Well, last week we had the CPI and the PPI, and they moved up. Okay, so they're not going down; they're going up. These are, the core CPI and PPI. Okay, how about housing? Well, today Case-Shiller came out, the 20 city home price index, and U.S. homes rose by 5.9% from the previous year in July of 2024. Okay, so housing prices are going up. Stock market's at all-time highs. Everything is great and grand. Okay, unemployment is, well within the 4%, which is okay for most economists. Okay, inflation's under control, allegedly. Why do we need rate cuts? Okay, well, maybe China's telling us why, because the whole world economy is slowing down. Okay.
Right.
Well, what about manufacturing? Well, we talked last week about the PMI manufacturing and how it's not doing so well. Well, the fifth district manufacturing index came out today, and it was edged down to negative 21. Okay, in September, and that was from negative 19 the previous month. So we're getting worse. Okay, and it was worse than forecast of a negative 17. So that indicates the steepest decline in factory activity since May of 2020. Okay, which was right after the pandemic started. That's where we are in manufacturing, at least in the fifth district. And we've seen all these districts kind of go through that. And the whole thing with the PMI, the same thing. And then we talk about labor. Well, how's the labor market doing? Well, let's talk about this strike that could come up on the East Coast, on the docks. So American
Right.
consumers may soon have to do without some popular fruits, including bananas, when they are grocery shopping, as fruit aisles could be empty and prices may soar if 45,000 dock workers threatening to strike end up walking off the job. And I think that's just October 1st. They're going to talk about that. That's a week away.
Uh-huh.
International Longshoremen's Association, or ILA, is negotiating on behalf of the 45,000 dock workers at 3 dozen U.S. ports that collectively handle about half the nation's seaborne imports. The group said its members are prepared to stop working if they do not have a new contract by October 1st. Here's the demands, and man, I wish they represented me. The ILL's demands include an 80% pay raise over the next 6 years, claiming that workers deserve a share of profits foreign-owned container carriers received during the pandemic. That's pretty sweet. Okay.
That's
So
humongous.
that's going to be quite a negotiation. That's 45,000 people out of jobs, plus everyone else, who unload who take the trucks, who, warehouse it,
There's
secondary and tertiary economy. That's what's coming up. Okay. And we don't even have to wait for them because Boeing is already on strike, 30,000 workers at Boeing. Okay. They're already furloughing the management of Boeing. And what about the suppliers to Boeing? They're not going to keep producing to send into factories that aren't working. So they're going to have to furlough, and what about the raw material suppliers? And what about all the people where these people go to lunch, every day, in the gas
right.
stations around these factories? They're all going to be hit. This is the
It's
way
just
the economy works.
it's
Go
it
ahead.
all the way down from Boeing to mom and pop who serve meat and threes in these
Yeah.
small towns.
Yep. Exactly. And so the Fed is seeing something that I don't see. I mean, I look at what's happening daily and say, well, that can't be good. Okay, so Boeing was hoping to end its 2 week strike or two straight strikes already, and said that its best and final offer includes 30% raises over the next 4 years. Maybe they should get the ILI to represent them.
Right.
They were going 80% for the next 4 years, up from 25% the initial agreement, but still below the union's stated goal of 40%. The new offer also includes improvements to retirement plans, brings back the annual bonus that workers were disappointed to see cut in the previous contract. However, the union representing over 30,000 workers said that the offer was thrown at us without any discussion and that Boeing disrespected the union by releasing it publicly before the union was able to discuss the details internally. The union said its negotiating committee had no input on Monday's offer and said it does not currently plan to hold a vote on the offer after Boeing declined requests for renewed talks. So it doesn't sound like that's going to be solved anytime in the near future.
No.
Again, so this is part of jobless rates, and this is, jobs are going to get better and blah, blah, blah. I don't see it today. And this is just today I pulled off, this isn't what happened yesterday, last weekend,
Right.
or
Or the
Paramount.
last three
Okay.
months of what's happening.
No, no. I mean, we go over it every week. Paramount is implementing another round of major company-wide layoffs on Tuesday, today. In a memo to staff Tuesday morning, co-CEO George Cheeks, Brian Robbins, and Chris McCarthy, wow, they have three CEOs, said that the company will undergo, well, three CEOs, wonder what they pay those guys. Anyway,
Right.
said that the company will undergo phase two of its worker reductions today, but that by the end of the day, 90% of these reductions would be complete. Well, maybe they could get rid of two CEOs and then they only have one. And that would,
Right. Save some money.
yeah, I know. Um, anyway, that's up to them. Southwest Airlines has warned employees that it will announce some tough decisions in coming days under a plan to restore profits and to help fend off changes being demanded by activist Elliott Investment Management. So there's Southwest Airlines, solid airline. Even they're talking about, there's going to be some issues coming up. So I guess to conclude my mini rant today, why do we care about China? Well, because China is part of the whole global supply chain. Why do we care about dock workers? Because dock workers are part of the global supply chain. Why do we care about Boeing? Boeing's one of the largest aircraft manufacturers in the world. And if they go down and they stop production and they stop functioning, it's gonna stop everyone from functioning. We're gonna come down to another shutdown. Okay. So how do they not calculate this into the future and how the economy is good and how I know the answer because the markets are not the economy. How do stocks around the world go up when China is in so much trouble? They have to start printing money and flooding their country, and not only that, admittingly trying to stoke their stock market up. Are they going to do that forever? What happens when they stop? So that's where we are today. And I hate to be a gloomer again, but find me some happy news. Okay. and I'll be happy
Emerging
with that stuff.
markets.
Emerging
Emerging
markets.
markets.
There you go. But
There
here
you
at the
go.
Bank of China, everything is fine.
You're right. Emerging markets up 3% today on EEM. Why? Because
Commodities.
you lowered rates, made emerging market debt cheaper to service. Commodity prices will go up because most emerging market countries are commodity based related companies or countries. And so all of a sudden you're seeing this rotation from US high beta, high technology to all of a sudden emerging markets. That's interesting. And if the Fed does lower rates to 3.5%, imagine where emerging market indexes or companies are going to be at in the next 12, 18 months. I mean, there's your opportunity, there's your ray of light. But I think it's a bigger issue here in the United States because of what everything you went through. I mean, 45,000 people going on strike, and all of our goods that are come in to the United States, majority of it comes into the East Coast,
Half of it at
and
least.
you can't get it. You know,
And what's coming
Ginger,
up? Christmas season.
Christmas season, I got a supposed hurricane in the Gulf of Mexico right now. And Ginger went to
Absolutely.
get gas, and she goes, half the pumps are empty now. Yeah, grocery stores are starting to get cleaned up. What happens? You have this storm roll through, they go on strike. Yeah, on the East Coast, on the dock workers go on strike. We can't resupply our grocery stores. What happens to the price of everything? It goes through the roof. And I
Well,
think that's why they're,
I don't know where that hurricane's going, but if it's coming through the Gulf, it'll probably affect the energy complex too, I'd imagine.
I would, yeah. I mean, we'll know more tonight of what it becomes. It's not even a hurricane yet or a tropical storm, but supposedly tonight it will become official tropical storm. But those are the things that you got all these variables that are affecting our country. And yet they come out and say, oh, yeah, we just lower them 50 basis points. Everything's okay. Economy's good. Yet, non-farm payroll hiring in the last 3 years has dropped 16.9%. It's not all good, folks. And I think that's the thing is what, like you pointed out, like Boeing. Boeing's got what, 30,000 people that are on strike? It's not Boeing and those people getting paid that it affects everything down the line. And that's what I don't think people recognize. And I was thinking about this yesterday. So, what is the solution to all this? You brought up, because we were talking healthcare offline, about let the free market price stuff. Am I correct on how interpreted that? Let the
Yep.
free market price what mortgage rates should be, what prime rates should be. Let free market price what salaries should be, healthcare should be. Instead of trying to control it at the Fed or you know, at in Washington D.C. because they
I
don't know
think
what
it
they're
goes.
doing.
I think it goes back to when the U.S. came off the gold standard. We
Yeah,
had stable rates. We had stable money. Now we don't. Now we have inflation. Now we have the basing of the currency. Okay,
yeah,
because we can print as much as we want without anything backing it. So so my dollar doesn't mean as much. I can't buy as much. My purchasing power is down, and on top of that, I have inflation. Okay, so I need more money to buy less goods. Is where we're
yeah.
at right now, and it's just a non-ending cycle, and we're still printing money today, and pretty much, sacrificing the future of America's children and grandchildren. Because
Mm-hmm.
somebody's got to pay this off, or they're just going to have to reset. And that's what recessions used to do. Recessions didn't used to be big old global financial crisis. They used to be, around at different places. And what that did is reset asset prices to where they should be because they got inflated. And now we have the Fed with interest rates set so low for so long. And then the pandemic came, and then we printed all this money and we gave money to everybody, and they went out and spent. Okay. And now that money's gone, but the debt is higher. And and the asset bubbles have increased. We've got housing at all-time highs. We've got gold at all-time highs. We've got equities at all-time highs. You know, it's and yet we're cutting rates. Why? Because they know what's coming. I
Hmm.
believe, and I think I know what's coming because I've lived through it 3 times before. Okay,
Right.
and this story keeps repeating, and we do it every single time.
Yeah. And I think that, and the thing is, it's like going back to my earlier question, how do you get back to normalcy? And the unfortunate part of it is to get back to normal or the mean, it comes in a very violent, destructive way for people's wealth, people's livelihoods, all that. I mean, if this is the average or the mean, and we're up here, typically to reset, we got to go here. And
Mm.
we saw that in 1929 into the 1930s. Um, and things reset themselves. And then, of course, like you pointed out, Nixon came off the gold standard, and here we are again. So, um, I guess the question I have is it how long do they kick the can down the road? How long can they do it? You know, they've been doing it what 14 years now after the great financial crisis. Um, how long can they do this? So we got, I mean, can can they get another five, another 10, another 15 years of doing this
As long,
policy?
I think as long as investors accept the debt as the U.S. Treasury is valid and repayable, it'll go
Hmm.
on. When's that going to end? You know, we
Yeah,
already have Japan and China are not buying as much of our debt. Like China's shorting our dollar. Okay, so uh, it just you keep printing until you can't.
right.
And we have examples all over the world. The Weimar Republic, the Romans, the Spanish, the British, all went through the same thing when they, were the king of the world. And
Yeah.
we're just doing the same thing. And no one
And
has the guts to stand up and say, stop, because you can't cut this program over here. You can't cut that program over here. If you cut that program, then I got to get rid of the Department of Redundancy Department. Okay. And those people will get laid off. And well, you know what? That's the way that the economic cycle goes. Okay.
hmm
And you go and you move on and you do other things, you know,
yeah,
but it's natural. You don't have winners and losers picked by different departments of a government, or a party. And that's where we got away from the free market, I believe.
yeah. I think, how do you reduce spending in areas? You allow the interest that you're paying on the debt we have starts to eventually take away from programs. I think if
All right.
I'm
I
right
mean,
on this,
it's $1
there,
trillion dollars.
yeah, our debt is now, um, the interest on the debt is bigger than the military budget. I believe that is correct. But
It's
think about
close,
it.
if not.
Okay, at some point, where did we have to pay the interest on this debt? Where do we take the money? What's the number one thing we need? Protection. We need in the system right now protection because everybody's gunning for us. And so if you start pulling money from military, then all of a sudden you just put your arms down during a UFC cage fight. You just don't do that. So yeah, I think we have to figure out how to do this um, if we're going to not have a reoccurrence of the 1930s, in my opinion. And that's extreme, I know. Yet we're really at extreme times if you think about it and look at where we're at. It's just, ugh. But like I said, there's opportunities as well in
Well,
this. And it's understanding how this all works that you can then identify opportunities.
and that's why we have the platinum channel, because there's always there's always a bull market somewhere, as our friend Jim Cramer says. And what we do in swing trading is we go try to find, the gems that are out there. And again, it's farther and fewer in between right now. Um, that will give us an opportunity for the highest probability of a successful trade, you know.
Hmm.
And then when there's not anything there, we sit out, let the market go by and do its thing, wipe out whoever it's going to wipe out, and then we come back in when it's more favorable to us. And
Yeah.
right now, that seems to be a pretty good strategy because think about the people in the great financial crisis who held, and I'll hear the story. Yeah, but if you waited, it all came back, and then look at what you did. And I'm like, well, yeah, but if you would have got out and saved that principal amount, waited and got back, you still could have wrote it up, by using technicals, and you wouldn't have to
Right.
have waited and lost that opportunity cost.
And that's we're introducing a new service. It's a good lead in, by the way. A new, more long term core allocation service to the Gold channel, which is 19.95 a month. But it is more of that intermediate to long term investor. We were talking on the call today or on the Discord live, which is available to platinum members, but there's also one for the gold members. And it basically it's like, here's my lifestyle, as one of our members said. Here's my lifestyle. I got two young kids. I got a job. I got this and the other. I can't spend all my time looking at the computer and studying charts. But I do want to swing trade, but I also need that core portfolio allocation that does ebb and flow and sidestep some of these big potential blowups that could set you back, 5, 10, 15 years when it comes to your goals and retirement and that kind of thing. And that's a new product that we're launching in the next couple of days within the gold channel, but as well as we're upgrading platinum with some different services, and we'll be releasing information on that later this week, possibly first of next week. So, and it's really to help you protect what you have. Mark's been through what, three major crashes?
Since '87, probably more than that.
87. Okay. Dot com,
Well,
how
I
great
mean,
financial.
I grew up during the last, big recession and stagflation during the '70s and,
Yeah.
'80s, when we were in recession in the '80s with OPEC and all that, the gas problem that
Yeah.
we had. We didn't have any. So, yeah, I mean, this isn't all new. This isn't a new thing for
Yeah.
economies. We go through these cycles.
Yeah. And they're big cycles. And the thing is, each of those, going back to 87, the amount of money in the system, the amount of leveraged money, margined money has gotten bigger and bigger and bigger each time, which creates bigger and bigger crashes. And I think that's, the one thing we're trying to do is say, hey, here's the data, here's the information, here's a strategy. Here's are you gonna, is it gonna prevent you from losing everything, a little bit or something? No, but it's gonna keep you from being set back 5, 10, 15 years. And we've had some people who've joined our channel who said it took them 13 years to get back to even after the great financial crisis because they buy and held the index. And I think the other thing is people don't take into account the fact that in the last 6 months the US dollar has lost 3.69% of its buying power. So that factors in to those retirement goals. And
Well, and the
there's
rate
a
of
way to
inflation.
do this.
Yeah.
There's a way to do this. Yeah.
We
So,
just want to we just want to help empower you as regular people to help take control of your own situation and think about things differently. We don't tell you what to do, okay? We just show you some alternatives um, that maybe would help you, stabilize a little more before
yeah,
in the next crisis, or help you actually build up your wealth a little bit by thinking
yes,
about how you look at technicals and fundamentals differently.
yeah. And create a process. How do I, that's one thing we were talking about today on the Platinum Live was what's the manual? You join our group, what it is, and we're developing that step one, step two, step three, step four. Here's a 90-day game plan. Here's how to get yourself knowledgeable, comfortable, and feeling more secure about your financial future when it comes to investing. So we'll also be releasing that in the next couple of weeks as well for members who, subscribers, and give them basically a here's how to start, and here's how to build your own process of investing, because like your process is different from mine versus different from Paul's, and everybody else. So that's what we're all about. So anyhow, Mark, any other joyful news you got on the docket
That's
today?
about as happy as I can get today. So,
Okay.
yeah, but I'm hopeful for tomorrow. So we'll see what
Yes.
happens tomorrow.
Sun will rise.
I'm
There's
hoping
another
Janet
chance.
Yellen comes out and gives me a speech that I can at least smile about.
Right. Good luck on that. Anyways,
Yeah,
I would recommend something else.
yeah.
All right. Well, thank you for joining in Two Guys Regular Show or Two Guys Regular Show.
Two
I
regular
am
guys show.
Trent. What did I say?
But you said the regular two guys show.
Oh,
I
Two
said it's two
Regular
regular
Guys
guys.
Show.
Yeah,
Sorry. I got a lot on my mind. Uh,
yeah.
I'm Trent, and that is Mark. Wow, I got the pointing pick figured out
Sit there.
today.
Yep, sit here in China.
Yep, and you're in China. I'm down here in weather, weatherly Florida. Hopefully we will sidestep our hurricane. But anyhow, hit the subscribe button, hit the like button, and always check us out at www.bus13.ai. That's bus13.ai. That's our website. We are over the next couple of weeks upgrading our website to make it a first thing in the morning destination spot, along with our upgrading of our different services and an introduction of a new service, the Silver Channel, in the next week or so. So check us out at www.bus13.ai and hit the subscribe button, the like button, and we will see you next time. Peace. Live loud.
Ding, cut.
All right.